Somewhere in a filing cabinet or a drawer or a folder on a laptop you have not opened in years, there is a document you signed and have not looked at since. A trust deed. The accountant slid it across the desk, said the words asset protection and succession and flexibility, and you signed it. And every June since then, you have signed a distribution minute without ever being entirely sure what it was doing. In July, Treasury released a paper that changes what that document is for. A discretionary trust is a simple idea wearing an expensive suit. A trustee, usually you or a company you control, looks after assets for a group of people called beneficiaries. Each year, the trustee decides which of them gets what. The trust itself pays no tax on the income it hands out. The beneficiaries declare it and pay tax at their own marginal rates. That is the machine. Now, the reasons you were given for wanting one. Asset protection. The assets sit with the trustee rather than with you personally, so if the business goes under, they are a step removed. Succession. Control passes by changing who the trustee is, instead of transferring every asset one at a time. Both of those are real, and the government's own budget papers say so, in writing. And then there is the third reason. The one that tended to be said a little more quietly, usually with a smile. Income splitting. $200,000 of trust income does not have to land on one person in the top bracket. It can go to you and your spouse and the daughter at university with no other income in $50,000 slices, each one sitting in a low bracket. And when the low brackets ran out, there was the bucket company. A company added as a beneficiary which takes whatever is left at the flat corporate rate and parks it. This is not a fringe arrangement. Australia has more than 1 million trusts, and around 840,000 of them are discretionary. In the 2022-2023 year, they distributed just over $140 billion. Per head of population, Australia runs about 40 trusts per 1,000 people. Britain runs about 2. Nothing about this was sudden. The budget fact sheet contains a small table, and it is the most quietly devastating thing in the document. It lists the tax reviews that raised concerns about trusts. The Asprey Report, 1975. The Review of Business Taxation, 1999. Australia's Future Tax System, 2009. Rethink, 2015. 50 years of reviews, all pointing at the same door, and the door stayed open. So the honest answer to what happened all of a sudden is, nothing happened all of a sudden. A door that had been rattling since 1975 finally blew shut. But here is the part that should actually make a trust owner sit up. The minimum tax does not simply make your trust more expensive. It flips the ranking. The government put a worked example in its own fact sheet. Kurt runs a business through a family discretionary trust, $300,000 of income. He pays himself a salary of $100,000 and splits the remaining $200,000 across 4 extended family members who have no other income. Total tax across the family, about $42,000. Loretta runs the same $300,000 business through a company. Same salary. The rest retained in the company at the small business rate. Total tax, about $72,000. Today, the trust wins by roughly $30,000 a year. From the 1st of July, 2028, if Kurt changes nothing, that same trust pays about $86,000. The company, the boring option, the one you were told was for people without an accountant, becomes the cheap one. The structure sold to you as the clever one is scheduled to become the expensive one. Not because trusts stop working, because the thing they were quietly for stops working. So who actually benefits? Start with the stated one. The Treasurer has said the money raised helps fund income tax cuts for workers. Whatever you make of that, it is at least said out loud. The wage earner on $200,000, who cannot split a salary 4 ways, is meant to come out in front of the investor on $200,000, who can. Then the second beneficiary, which is where it gets interesting. There is a rollover. For 3 years from the 1st of July, 2027, assets can be moved out of a discretionary trust and into a company or a fixed trust without the federal income tax and capital gains consequences that would normally follow. From January 2027, the Small Business and Family Enterprise Ombudsman will be standing by to help small businesses work out their options, and the corporate regulator is putting arrangements in place to help them incorporate. That is not a government hoping you stay. Now think about who actually builds that off-ramp, trust by trust, deed by deed. The profession that set these structures up in the first place gets paid once to build the thing, and paid again a decade later to take it apart. That is not a conspiracy. It is simply what happens when a country runs its wealth structuring through a professional services industry. And then there is the quiet part. The rollover is Commonwealth relief. What the government has described is relief from income tax, including capital gains tax. State transfer duty is a different tax, levied by a different government. And moving a property out of a trust and into a company is, in the eyes of a state revenue office, a transfer. If your trust owns nothing but shares, that may be manageable. If it owns a unit at Mermaid Beach and a shed at Yatala, the exit looks rather different. The accounting body CPA Australia raised precisely this within days of the paper landing. The states have not been brought along, and the duty question is unresolved. The Commonwealth has built a door. It has not paid the toll on the other side of it. So which half are you in? Because that is genuinely the shape of it. The budget papers say around half of all discretionary trusts are not expected to be affected in any given year, and more than 9 in 10 small businesses. This is a minimum tax, not an extra layer. Where a trust already distributes to people paying 30% or more, the papers say there is no overall increase in tax paid at all. The floor is simply lower than where you were already standing. And be clear about the direction of travel. It is a minimum, not a maximum. A beneficiary already in the top bracket still pays top bracket rates, with a credit for what the trustee has paid. The floor comes up, the ceiling does not move. Where it bites is the low bracket. The credit a beneficiary receives for the trustee's tax is non-refundable. So on a distribution to someone with little or no other income, 30% leaves at the trust level, and the excess does not come back as a refund. That is not a side effect. That is the entire design, aimed squarely at the arrangement you were told was the clever bit. The second bite is the bucket company. Corporate beneficiaries receive no credit at all, and the government says that is deliberate because it stops the minimum tax being cycled away through a company. The budget papers also note that of the 80,000 companies that received a trust distribution in 2022-2023, Taxation Office data showed more than 8 in 10 had no evidence of business activity. There is a second thing buried in that same paper. A measure announced in the 2018 budget and left on the shelf ever since. Bringing unpaid present entitlements, money a trust has promised a bucket company but has not actually handed over, inside the Division 7A rules. Treasury is asking how to implement it. If there is a paper entitlement sitting in favour of a company in your structure, that is the other page in this document with your name on it. And the carve-outs are worth knowing because they are wide. Primary production income is excluded. Testamentary trusts are exempt. So are complying superannuation funds, charitable trusts, special disability trusts, deceased estates, fixed trusts, and widely held trusts. If what you have is a farm trust or a will trust, a great deal of this is not aimed at you. One mechanic that gets very little airtime. The budget papers point out that wages are not trust distributions. Where a family member actually works in the business, paying them a salary does not attract the minimum tax. The government's answer to all of this is the rollover. The counter-argument, which you will hear from a lot of accountants, is that relief on paper is not the same thing as a restructure you can actually afford to carry out. And none of it tells you what to do about your own deed. It is not law. Consultation is open, the design can still move, and whether your structure still stacks up depends on what is inside it, who is in it, and which state it sits in. That is a sit down with a registered tax agent question, and this is one of the rare occasions where that sentence is not a cop-out. But step away from your own deed for a second, because there is a larger question sitting underneath all of this, and what follows is only my 2 cents. If the Commonwealth genuinely wants people out of discretionary trusts, it has built a door and left a toll booth in front of it. 3 years of federal relief on the way out, and a state duty bill waiting at the gate. Had the Commonwealth and the states agreed a matching duty exemption for a genuine restructure inside that same window, no change in who really owns what, no cash taken out, just a change of wrapper, the exit would be an exit rather than a fee. Without it, a reform built around fairness risks sorting people by something else entirely. Not whether their structure was fair, but whether they can afford the duty to walk out of it. That is my 2 cents, and it is only that. Here is what I would like to know from you. When your trust was set up, what reason were you actually given? Asset protection, succession, or the tax? And did anyone tell you which one was doing the heavy lifting? Tell me in the comments, because I suspect the honest answers vary a great deal more than the brochures did. And if there is a system you want pulled apart, a bill, a levy, a rule that does not add up, drop it in the comments. That is where the list comes from.